The parallel channel is an important tool to add to your TA toolkit for several reasons. First, the simple geometrical tool can be used in identifying a change in trend, which is a cornerstone of any great trading strategy. Secondly, especially in combination with other forms of TA such as Elliott wave theory, Fibonacci analysis, and algo targeting, the parallel channel can help you refine those other forms of TA and can be used in combination to set specific trading tactics, whether swing trades in larger time frames or even day trades. Last but not least, it's a valuable tool in risk management. The parallel channel, especially in combination with technical and validation points from other forms of TA, but even without those, can be used to set stop loss levels and take profit targets, either full or partial. So we won't cover all those topics here today, but I wanted to illustrate the power of this channeling tool in identifying trends that can be traded. We're going to take a very simple three-step approach here, okay? And this is the approach I personally used to go from unprofitable to profitable trading many years ago. The first rule is that you're going to enter, once in a trade, you're going to stay in that trade throughout the duration of the price traveling throughout a parallel channel. And the way that you're going to draw the parallel channel is you're going to select two significant pivots that move against your trade. So if you're long, two deep negative retracements, and if you're short, two spikes up in price against your short position. And then you're going to connect those two through a parallel channel, pull it up or down depending on which direction you're trading against the next major pivot on the other side. And so long as the price is contained within that channel, you're going to stay in your trade. Now, if there's a pivot that breaks out of the channel in your favor, then you're going to ignore the first pivot against you and wait for another third pivot that would become the second pivot now that you connect to your last pivot against you to reform the channel. Okay, this will become clearer in this example. And then you'll stay in the trade until price moves out of the channel against you. Once you're out of the trade, you will reconsider entering once a 50% or greater retracement has occurred in price, but you will get out, just like any algo would do, if the golden pocket, 618 to 65%, gets breached. Okay, this will also become clear in this example. This simple three-step approach would have been able to capture the majority of this price record's profits available throughout the major swings, and it would have kept you out of boring sideways action, or potentially dangerous or much more difficult to project sideways action. Okay, so I'm here on the 2-day time frame only because that fits the entire price record in one chart, but you can use the same strategy on the 15-minute time frame or the monthly time frame if the price record is long enough. Let's assume that you bought the IPO and you stayed in it throughout here, and you're starting to use the parallel channeling strategy that I just described. So you would have stayed in. There's a deep retracement here, or somewhat deep, looks like maybe 50% or so. And this would have been your first major pivot. You would have stayed in, taken the drawdown, and this would have been the second major pivot. Now, obviously, with the price history in front of you, it becomes more obvious when to get in and out. But remember, we're assuming that all we're seeing right now is this price record up to here. Okay, so you would have pulled a parallel channel from the first pivot against you to the second major significant pivot against you, pulled it up, and connected this last pivot. And this would have been your channel. It would have kept you in the trade from wherever you got in here all the way to here and down, and then all the way back up, and you would have taken a little bit of a drawdown and gotten out here. As you can see, you would have captured the majority of this swing. Then you would have gotten in at the first 50% retracement of that price move up. So let's see if we pull a fib from here, the low point to the high point. You can see that right around this dip, you would have gotten broken out of your channel and stopped out around here. You would have started buying at this 50% level all the way through the 618, potentially down to the 6.5 to allow a little bit of room for wicks and such. And then you would have gotten stopped out below that. But here you don't. you get to the 50 and keep buying down to the 618, which you never reach, and then price rebounds up. Okay, so then you would have drawn the same parallel channel after two significant pivots. So you would have stayed in all the way up here, and then boom, the first major pivot gets put in. So you note that. Gone back up, second one gets put in. So let's draw that channel this way. Much flatter slope, but look at what happens once you draw it. Price goes parabolic. So you would have ignored this first pivot, you would have been happy to stay in this trade, and waited for the next major pivot, which would occur around here. Wouldn't you agree? So I'd connect this one to this one, pull it up to channel, until it connected this pivot right here. And you would have stayed in the trade all throughout the sequence. You would have taken a bit of a drawdown again around here and gotten stopped out right around here. Okay. Now, once you get stopped out here, you're looking for a 50% retracement to get in, but you don't get it. It goes shortly after you get stopped out a little early. Price shoots up, and you sit there and you watch in agony, but then it goes right back down. Still, this is not a 50% retracement of from when you got in. So you wait, and it goes sideways and up and sideways and up and sideways, and now it starts going down. Okay? By this move right here, you're so far out of any regular channel that can be drawn. Whoops, wrong tool. Even the widest channel, here or even here, by the time you get to this price level, you're so far out of it that alarm bells should be ringing. When you see a channel go from something that contains the motion so well like this one to something that's so wide that it's practically useless, there's been a change in trend. So right around this level, you should start suspecting it. It's confirmed around here. And now you wait for the first 50% retracement to get in on the opposite side. Again, using the channel as a trend identification tool. And you get it here. 50% goes here. And you keep shorting this thing all the way up to here. And you would have all the way up to the 618, but it doesn't reach it. It falls below it. Now once you're in the trade, what do? Again, we wait for two significant pivots against your position, which you're short. So two spikes up. You're happy, it goes straight down. This is the first such pivot. You note it. And it goes straight back down again. And you could be argued that this is this next major pivot. So you draw a parallel channel. Once again, very simple trading strategy. Something that looks like this. And you would have gotten in around here, and you would have gotten stopped out right around here. Now, yeah, you missed this. But you wait for a 50% retracement of this move. You don't get it, so you stay patient. You wait, you wait, you wait, you wait. You still don't get it here. Goes down, and it goes back up. Let's see if we get it here. Now, I haven't measured this, so maybe you won't. But you got in around here. Sure enough, you get it to the tick, maybe a little over the tick. So you're short here, and once again, you wait for the first significant pivot against you, which I guess some could argue it's this one. You could even use this one, but I'm going to argue it's this one. Okay, and then down here, and it looks like this one might be the second one. But as you can see, the price is so tight here that whether you would have selected this one or this one, it wouldn't have mattered. It would have been the same channel. So you draw it channel like this, pull it down, and you would have gotten stopped out right around here. Now, depending on your time frame and how much of a profit you're in, there's some room allowed for wicking, like here, a little bit of wick here. That's subjective, but let's say that we play the playbook very strictly, and the second it breaches the channel, you're out. So you've gotten out here, but you would have captured all this profit, Okay, and then it rebounds from here, but you never get a 50% retracement from your entry from here. And so, it goes sideways and then down a little bit, but this is not that interesting compared to the amount of profit you made here and here and here and here. Just by applying this very simple channeling strategy with a simple fib pool and the recognition of some key retracement levels, which is extremely basic, you would have captured the lion's share of the profits for this entire price record throughout a 12-year period. Now, if you want to play intraday time frames like hourly, 15-minute, or even lower, you could zoom into any of these wave sequences and probably find tremendous opportunity to use the channeling for day trading purposes. But this simple example illustrates that even for something this volatile, you can be quite a profitable trader taking very little risk by applying simple channeling. Come to TradeDevils.com and learn how to use this type of technical analysis in combination with Elliott wave theory, algo targeting, Fibonacci analysis, geometry, and much more. Level up your trading.